Hey dreamers, today we're going to challenge a common belief about finance, and that is the notion that debt is bad. I'm sure you're thinking, how is it possible for someone to make a video saying that debt is good? Well, yes it is, and it's not always in the way you might think, because debt is not inherently negative. Welcome back to Passive Income, where we turn dreams into streams of income. In today's episode, we're diving into the world of debt strategies to build wealth. It's very likely that you have credit card debt, car loans, or even student loans, and you may think that it will take you many years to pay them all off. But how can this actually be a good thing? Stick with me as I reveal the 5 ways the rich make money from debt. Most trade is based on debt. Much of the world's trade is based on debt. While this idea may be controversial, borrowing money to start a business may not seem like the best idea. However, there are businesses, especially traditional ones, where using debt may be the best alternative. Let's say you want to sell keychains, a very common product that is always in demand. Ideally, you'd travel to China and find a factory that produces high-quality keychains at the right price. You buy a container of keychains and ship it to your country for distribution to your customers. Today, most of this is done online through sites like AliExpress, unless it's a more specialized product, in which case you'd have to travel to the factory to supervise production. The interesting thing is that you don't have to pay up front to get the products. Let me explain. Over the past 5 decades, China has become the world's major producer of virtually everything you need. In this country, thousands of factories are working non-stop to produce goods to meet global demand. Most of these factories are willing to sell their products on credit to facilitate sales. However, these loans aren't given to just anyone. You have to establish a relationship of trust with them. Yet this is the way business has been done for the past 50 years. Once the customer sells the product in the United States or anywhere else in the world, they can pay the Chinese factory. It's essentially borrowing the products, helping the factory sell them, and adding a profit margin on top of that. The great thing about this strategy is that you don't have to use your own money in the transaction. That's why the ability to sell is one of the most important skills you can master. Forex, or the foreign exchange market. Forex is a market where foreign currencies are bought and sold, facilitating international trade by allowing the use of currencies like the dollar in countries where it is not the local currency. Suppose, as mentioned at the beginning of the video, you've already sold the keychains imported from China and need to pay in yuan. You can use Forex to purchase the necessary yuan in the market, and thus complete the transaction. Both individuals and companies can participate in this market to acquire foreign currencies. The value of currencies in the Forex market can be influenced by various factors such as changes in a country's economic policies, geopolitical events, fluctuations in commodity prices, and other economic indicators. For example, if the Federal Reserve System decides to raise interest rates, the supply of dollars in the market might decrease, leading to an appreciation of the dollar against other currencies. If one can successfully predict the market's direction, significant profits can be made in currency trading. What makes the Forex market unique is that, compared to other financial markets, you can obtain very high leverage. This means that for every dollar you deposit, you can trade with a much larger amount, in some cases up to 100 times more. This allows you to make substantial profits even if your initial investment is relatively small, since leverage amplifies the value of your trades. Hedge funds. High-risk funds are investment strategies designed by and for wealthy individuals with the goal of achieving higher profits. Unlike conventional investment strategies, where the aim is to predict which companies will experience growth and appreciation in the future, hedge funds employ tactics that aim to generate profits when companies face issues or experience drops in their value, as was the case with GameStop in 2021. Although in this situation they challenged hedge funds and caused them to lose over $13 billion. The way these hedge funds profit is through leveraging. For instance, if it's anticipated that the value of a stock, like Facebook's, will decrease due to an announcement from Apple about restrictions on online tracking apps, this could negatively impact its business model. In such a scenario, you call your broker and request to borrow a share of Facebook. Let's say it's valued at $100. You then immediately sell this share on the open market for that same value. Now you have that $100, but you will have to return the borrowed share to your broker later on. Let's say the prediction is correct and the price of Facebook stock actually drops to $70 the following week. At that point, you can use the $100 you earned from selling the borrowed share to buy a new Facebook share at $70, making a profit of $30. But while this strategy seems simple, there are risks involved. What if your forecast is wrong? What if the stock suddenly doubles? In that case, you would still have to return the borrowed stock to your broker and pay interest. If the stock now costs $200, you'll have to buy it at that price to return it. If you invest in a stock with the intention of selling it and it goes up, the maximum risk is that you lose the amount you invested, unless you go short, in which case the losses can be potentially unlimited if the price continues to rise, since theoretically stock values can go up indefinitely. However, if you have a team of analysts working for you, you can make significant profits with this strategy. Refinance real estate debt. A mortgage is one of the best forms of debt because it comes with many tax advantages. If you don't have a mortgage, you have to pay additional taxes. Therefore, the wealthy always try to have multiple mortgages to take advantage of all possible deductions. Every dollar saved in taxes is a dollar earned. So this is another way the rich get richer. To illustrate this, suppose you have $100,000 in savings. While this may seem like a substantial amount to many people, it's relatively small to the wealthy. You can't buy a house with that amount because you'd need at least 20% down. But here's the thing. Imagine you find a property worth $500,000 that needs significant improvements. Go to the bank and get a mortgage with a 20% down payment, assuming you'll spend 10% of the total cost of the property on repairs, or about $50,000. Then go back to the bank, but this time to refinance the mortgage. When you got your first mortgage, the property was worth $500,000 because it was in bad shape and no one was interested. But since you renovated it, there are families interested in renting it, and the market value of the property has risen to $750,000. Just like the first time, you'll get an 80% mortgage, but 80% of $750,000 is $600,000. $400,000 of that money goes to the first bank that gave you the first mortgage. And after subtracting the other $50,000 you spent on renovations, you're left with a profit of $150,000. You earned $150,000 with that debt, and now you have a property that you rent out to build equity and generate passive income. On the other hand, you'll avoid paying taxes because you have a mortgage. This is a practice frequently used among real estate investors. Now, knowing this, do you still think debt is bad? The credit note. Most commercial businesses and successful entrepreneurs use the credit note in various ways. Particularly, if you have a successful business, virtually all companies use financing to place orders. Therefore, it shouldn't be seen as something negative. Unlike high-interest debts due to higher risk, such as credit card debts, you can get lower interest rates by minimizing borrowing risk. How is this achieved? By building a reputation as a reliable borrower. There are billions of dollars in banks waiting to be lent out. And even if there's no money, banks can create it. That's how capitalism works. Understanding debt is your first step towards building wealth like the pros. Thank you for tuning in to another video with us at Passive Income, where every financial concept brings you closer to realizing your dreams. Remember, whether you're dreaming by day about financial freedom or by night about a life of abundance, we're here to guide those dreams into streams of income. So, hit the subscribe button and join our community where dreams align with action. Tap the bell for notifications, because every video is a step towards turning aspirations into achievements. Keep dreaming, keep striving, and let's build those streams together. Until our next video, may your dreams, both asleep and awake, be the blueprint of your success. See you soon.